Okay, good afternoon, everybody. Can everyone hear me? Please wave. Great, fantastic. I'd like to welcome everyone to our technical webinar today. My name is Patrick Barry and I'm the Head of Wealth at Partners Wealth Group. Our webinar today is titled Roadmap to Recovery. I hope the word roadmap doesn't bring too much anxiety to all our Victorian friends and colleagues who are obviously suffering at the moment with the current lockdown restrictions that we're facing. Today's webinar will be focused on SMF strategies to assist you and your clients. We think you'll get a lot of value out of today's presentations. Partners Wealth Group has a long history going back 17 years of being one of Australia's leading SMSF technical partners for accountants, with expertise across audits, legal, administration, lending, financial planning and private wealth. And we always encourage our accounting partners to contact us at any time if you've got any questions in relation to any SMS issues or superannuation issues that you or your clients may have. There won't be any opportunity today for questions, but we do encourage you, if you have any questions, please make a call through the Partners Wealth Group where you can have a one-on-one conversation with one of their experts. We have a jam-packed agenda today, so I'd like to introduce our first speaker. Our first speaker today is Alex Swanson, who is our General Manager of Audit at Partners Wealth Group. Alex will be discussing recent changes to superannuation laws and the new independent guidelines for SMSF auditors. Over to you now, Alex. Thank you.
Thank you, Patrick. Okay, today all the information provided is of a general nature and you should seek professional advice if it's for your own personal circumstances. So today I'm providing an update on updates to SMSF changes to legislation and laws that's happened in the last few months. So the first thing is there's been a good change to the work test. So the work test has now been removed for members aged 65 and 66. And this was done by changing Regulation 7.04. So this means that you can contribute $100,000 NCC up to your total super balance of 1.6 for the years of when you are 65 at 1 July or 66 at 1 July. The next change we've had is a change to our LRBA borrowing arrangements. And this, as you can see on the our current standard LRBAs, the SMSF would borrow from a lender, give the money to a bare trust, and the bare trust would buy the property. And this is not an in-house asset if borrowing was undertaken by the SMSF trustees. With the new legislative instrument, which is registered in May, so it's in effect now, the bare trust can now borrow directly from the lender, and it's not an in-house asset if the SMSF trustees maintain all the borrowing obligations and the trustees' recourse is limited to the property. We had a small change, but it's a change to the Your Choice, Your Super. So employees with workplace determinations or enterprise agreements will have their choice of fund from 1 January next year. But we've still got a few changes through Parliament that haven't come through, and the first is the more flexible bill. And as we discussed, 65 and 66-year-olds are no longer subject to the work test, but the bring forward rule hasn't come up to is not up to speed yet, and that's because you need to amend the 97 and the SIS Act, and currently the legislation is in Parliament. It's gone through the lower house and it's currently in the Senate, and Senator Hanson's put a few changes which don't impact this bill, just sort of tag-ons to the general superannuation. But watch this space. Nothing's happened since August, so we hope this legislation comes through in the next few weeks. If it does go in place, it will be effective from the 1st of July 2020, but I wouldn't recommend introducing this until that legislation's been passed. And we'll let everyone know once that bill has been passed and obtained royal assent. A more controversial one is the change to SMSF membership from 4 to 6. This was, well, it was just introduced recently. It was introduced about 4 to 6 weeks ago in the Senate. It came from a Senate Standing Committee. It's been pushed back to the Senate Standing Committee, and they need to report back on 4 November. So this change was outlined in the 2019 federal budget, and that was to obviously to allow for extended families with more siblings in, or for transition of wealth. Once this gets a little bit further down the track, we'll certainly provide some guidance on the impacts of this change. One of the good things that the ATO has done recently is probably been very quick in providing feedback with all the COVID-19 changes. So these are all the main topics that the ATO has on their FAQ website, and sort of provides assistance for accountants and trustees on what they can do in relation to COVID. The first is some guidance on obtaining the $10,000 early release, then some guidelines on how to obtain that through the MyGov website. So you can obtain $10,000 prior to 30 June, $10,000 up to 30 September if impacted by COVID-19. The second is the related party recourse borrowing arrangement. So a number of trustees had commercial arrangements with the big banks, and the banks were offering them some lending relief, either to halt in repayments or interest-free arrangements. So this guidance was to help with related party borrowings to provide the same sort of relief to the super funds without causing a breach of SIS. So the tax office has effectively said that on the basis it's been commercial and you can document it properly, they will be taking no further action in litigating that. Again, with the temporary reduction, there's also a temporary reduction in the minimum payment of superannuation pension amounts. So this impacts annual pension, account-based pensions and market-linked pensions for the FY20 and FY21 year. So your minimum payments have been reduced by 50%. So some of the questions that were on the FAQ were, well, if I've met my minimum for the year, do I still need to take out a pension? And the answer is no. Another question would have been, if I've already overpaid the minimum or paid more than the minimum, can I go back and reclassify some of those transactions as commutations so I can reduce my TBC? And the tax office said no as well. In relation to the temporary reduction in rent, again, the tax office has been very clear that they allow you to provide, if you're the landlord, you're allowed to provide your related party tenant rent relief so long as they're impacted by COVID-19 and they can and you can appropriately support that. And rent relief can be up to 100% if that's what your business has been impacted by. In relation to in-house assets, a lot of super funds had got their in-house assets down to 5%. And with COVID-19, there was a pretty big hit to the markets, and a number of their investments have gone down, and the ratio of in-house assets had exceeded the 5% mark. Well, the tax office, this obviously being in excess of your 5%, is a breach of Section 82 of the SIS Act. The tax office have said, well, look, you have to put a plan in place to get that level down below 5% by 2021. However, look, if markets do correct themselves, they're not taking any action on super fund trustees as a result of the market correction. And another sensible guideline was with SMSF residency. There's a number of trustees stuck overseas that can't get back to the country. Again, the tax office said, look, we're not really concerned about that. We're not putting any resources to investigate those matters. The last point is the investment strategies. I know we've spoken before about the ATO's interest in investment strategies. Again, this is just in relation to markets that trustees need to review their investment strategies on a regular basis to ensure that they're meeting their retirement needs. And there's certainly no significant change as a result of COVID-19. As a result of the COVID changes, the ATO has also put out a draft explanatory statement 2020 D2, and this is for our 1322C trusts that are the landlord. So if you've got a 1322C trust and you've leased the business real property to a related party, and you provide rent relief or a holding of stopping of payments or interest-free payments or so forth. That might create a receivable in the trust, and that's a breach of section 13.22D. And any breach of 13.22D blows up a 1322C trust, and the whole trust becomes an in-house asset. Again, the tax office has been quite sensible, and they have said that you don't need to report the breach for the 1920 years and the 2021 years, so long as the relief is on commercial terms from the impacts of relating to COVID-19 and appropriately documented. The receivable in the unit trust will not be an in-house asset. So turning to the recent federal budget, there's not a lot in it for self-managed super funds, but there's a few things in relation to superannuation. The first is an employee super fund will now be stapled to them for life. So if an employee changes jobs, you don't automatically join the super fund for the new employee. So that might mitigate that risk of employees having multiple super funds. They've asked the ATO to develop a tool to allow new entrants to compare super products on their MySuper on their super portal. Well, let's see if another ATO IT project comes through. They've also provided an obligation for funds to align their performance with the members' best interest to ensure that they meet retirement savings. The retirement savings are maximised. So this, as you're aware, self-managed super funds have SIS covenants, and under Section 652, trustees need to act prudently in the best interests of members. So this is an obligation more for industry funds. There's been some flack on some industry funds investing in the daily newspaper, maybe highly invested in some infrastructure funds or investing in properties that or building activities that create jobs for the members. So this is putting more pressure on the trustees to act in their best interests. But I don't know how this is going to be policed, because it's very, very unlikely that a member of a big industry fund can take the trustee or the board of a big corporate to court. The last measure, which is a little bit controversial for some of these industry funds, is that the APRA is going to benchmark superannuation products, net performance indicators, and trustees will be accountable for their performance, and they may have the power to restrict super funds from taking on new members. So it's about time that the industry funds have had some legislation to make them to perform. So again, they've in the early days they've shown that they don't like this change, but we'll see how this pans out. Now, the big change that we've had recently is the changes to audit independence. Now, this is as a result of APES 110 Code of Professional Ethics for accountants that was in place from the 1st of January 2020. Now, this code was actually passed in 2018, but was effective from the 1st of January this year. And what made it particularly interesting was a practice guide that was issued in May 2020 with a full chapter on self-managed super funds. And this practice guide identified a number of scenarios where independence would be compromised by an SMSF auditor. And this is where the books were prepared by the auditor. You're carrying out the accounting and tax role and the audit function in the same firm. Carrying out the SMSF audit where the auditor was previously a consultant, partner, or employee. Close relationships between auditors and referral sources, and auditors contracting out audit work, and long associations with SMSF clients. So effectively, it came down to the provision of audit and accounting services from the same firm has been the major change as a lot of this independence rules. They're saying it's going to impact up to 200,000 audits in the next 18 months. So it comes down to two main principles. The first is that the SMSF auditor cannot audit an SMSF where the auditor, their staff, or the firm has prepared the financial statements of the SMSF, which is not a routine or mechanical service. And the second principle is that a firm shall not assume management responsibilities of an audit client. Now, unlike what I've mentioned before about COVID-19, the ATO has actually been quite tardy in providing feedback to auditors on how this change should happen. But they have outlined early on that for the 2021 financial year, the Commissioner will write to auditing firms and outline that they need to make a change. And they've advised that they will plan to commence compliance activities from the 1st of July next year. ATO Director Kelly Grant told the SMSF advisor that she expects all audits to be independent from the 1st of July 2021. She also indicated that you should be complying now because due to your potential issues with professional indemnity insurance, you may find claims which will be disallowed if you are currently independent. And that's because the law started on the 1st of January 2020. And the fact is that the ATO are not policing that law until 1 July 2021, but it is actually in place today. So in relation to routine and mechanical, which is a bit of an unusual term, there was, again, a podcast on the 4th of September, the CPA podcast with ATO Director Kelly Grant again, discussing what is routine and mechanical. And she was stating how that the trustee would need to show that they created the fund transactions and provided a trial balance to their fund to be administered and uploaded to the accountant system, that the financial statements produced would be based on the figures provided by the trustee, and the accountant provides no judgments and on how certain items would be classified. And she didn't really think that there'll be many trustees with the skills and knowledge that they could take on the responsibility of the financial statements. And then she understands that the industry has argued that, we've now got recurring transactions due to data feeds. You've got software like Clasp, 360 and Supermate that does a lot of the heavy lifting for you. Does that meet routine and mechanical? And they've also argued that there's no judgment because the data feeds do all the coding for them. And there's also arguments from accountants that they're very simple. Some funds have just got cash or a couple of term deposits, so they're quite simple. So there's not very much judgment required in preparing these accounts. Ms. Grant stressed that because the fund is mainly invested in simple shares or data feeds, the trustee needs to show that they've taken responsibility for the financial statements by pre-approving every single transaction rather than after the event. And she also states that we often find that the firm is responsible for setting up the accounting software, which I think is what we find. The vast majority of accountants do hold the BGL or the class license. And if there's any mistakes in relation to preparing the accounts, that the accounting firm takes it on themselves to fix the mistakes, not the trustee themselves. Now, there's been some big news this week, and on Wednesday, the ATOs in their October newsletter outlined what they thought accountants with in-house audits should be doing. And they indicated that there's 3 hurdles to get over. And the first hurdle, that the firm shall not assume management responsibility for an audit client. And since many trustees hand over the management of their fund to administrators or accountants rather than do all the work themselves, they believe that most firms do not get over that first hurdle. So if someone asks you to do their SMSF accounting, well, you take on that responsibility. That is the management responsibility. So therefore, you cannot do the audit. And she said, regardless of how simple the funds are and whether they've got data feeds or not, the audit client, you cannot conduct the audit if the accounts were done by the same firm because you've assumed management responsibilities. Now, the second hurdle is if a firm cannot audit where the accounting and bookkeeping service were provided unless they are routine mechanical. So as already mentioned before about what Kelly mentioned before, is the evidence of the preparation of the financial statements being routine and mechanical has to be approved. The trustee has to approve the records and the entries in the trial balance used for the pro forma accounts. She even mentions that the ATO may contact the trustees to confirm their understanding of the fund's transactions. So to see that the accountant didn't take on any routine or mechanical service. The third hurdle is that even if you've passed the first two, the firm has to demonstrate that they did not take on management responsibilities for the audit client. The preparation of the financial statements were routine and mechanical, and that they've addressed the threats that are not at an acceptable level. And this one's a perler. So if the fund is unable to demonstrate that the trustee's ability to take on the management responsibilities, then the auditor, their staff and their firm are unable to prepare the accounts, okay? So the firm must demonstrate the ability to take the trustee's ability to take on responsibility for preparing the accounts. The trustee has an accounting or similar qualification. You need to demonstrate that the trustee has got the capabilities of preparing the accounts. The auditor then needs to evidence that on file to get over the second hurdle, and that the preparation of the accounts are routine and mechanical. So I think it's fair to say with the three hurdles that the ATO has provided, it's almost impossible to be able to say that you can do audits of funds that are prepared internally. And look, I don't think you're going to go through talking to clients and getting their diplomas or degrees from 40 years ago when they did an accounting degree and prove that they've actually can do a set of accounts. So what does this mean? Well, some firms that I've spoken to have talked about a reciprocal arrangement. Well, I've got 50 audits, you've got 50 audits. I'll do your work, you do my work. Then we don't lose any money. Fortunately, this was again addressed in the Independence Guide, and it's prohibited action. So we've spoken to a couple of accountants who were talking about having maybe 2 or 3 reciprocal arrangements. If we sort of have 3 or 4 maybe, and we all sort of swap the audits around, maybe that mitigates the risk. Well, still a scheme to do reciprocal audits, so probably technically it's not compliant, but then it creates this huge compliance nightmare of how do you make a fair arrangement with 3 or 4 different firms. And the second thing that I've actually found is that that independent audit firms have a much better system in relation to quality and turnaround than accountants who did audits on the side of their own work. So you'll find huge issues in relation to turnaround when you deal with accountants that certainly don't do audits as their number one service. One of the options was to cease accounting and sort of segregate the audit business, but unfortunately you cannot do the audits if you've been a member, an employee, a consultant or partner in the last 2 years. So essentially that leaves you with one option, and that is to outsource your audits. So I'll leave you with a couple of ideas of what to look for in an auditor. We suggest that you should look for someone with a good reputation and who's got the capacity, the technical expertise, they have good turnarounds, and we like 100% Australian made and Australian owned, and with good data security, so ensuring that the data stays in Australia. That's the end of my presentation. I'm going to hand over to Rob, who will talk about some superannuation strategies.
Thank you, Alex. I'm just going to see if I can share my screen here. Okay, thanks very much. So my name is Rob Hand. I'm one of the senior advisors here at Partners Wealth Group. Thanks for your attendance today. So today I'm going to go through some SMSF strategies to get your clients out of COVID and ahead of the curve. So I guess when we're talking about strategies to get your SMSF out of COVID, I'm going to focus on those strategies that we can accumulate your clients' superannuation balances to the most effective level we can get them to. So one of those strategies is limited recourse borrowing arrangement, which you've probably heard that as a technical term. For when we're talking to clients, usually that is talking about purchasing a property in the superannuation environment using lending. And so what we've seen in the last few years in regards to this strategy is probably a little bit less interest in it, mainly on the fact that interest rates outside of borrowing within the super fund have come down to around about the 2.5–3% from an investment point of view, where interest rates in the SMSF world are still around that 5 to 6.5%. We're also finding that there's less banks in this space, it's harder to get a loan, and obviously the main things there are the higher cost of setting up the structures, and it is a bit more complex. And why it's more complex is obviously when you're doing a strategy like this, there are multiple professionals that are needed to get that done. So that might be an accountant is usually most definitely involved, and a lot of the time is the person that clients have spoken to first. Someone like myself as a financial advisor will usually be the project manager of that if at work alongside the accountant. But then you also need lawyers in terms of setting up the bare trust structure and conveyancing, and then you've got your lending as well. So putting all that together makes it a bit of a more complex process. So that's probably where we've seen the drop off. But I think this strategy still works very well, and I'm going to run through why I think so. So when we're talking about buying a property in super fund, and this is irrespective of whether you're buying in super or outside, the main thing that we want to try to get out of this from a financial planning point of view is really we want growth to grow on growth, and that compounding effect of buying a property is how you you see properties that you bought for $100,000 now worth $1 million. So we want to maintain that, but I guess in the superannuation environment, what we're doing here is utilising borrowings to increase our exposure to a growth asset. And irrespective of that interest rate differential, if you can get that right, your outcome is going to be far better than leaving your superannuation ungeared. The other side of it is the compounding of taxation benefits. So, with superannuation, obviously taxation is at 15%. When you've got a loan associated inside the self-managed super fund, we're seeing those overall tax rates drop down to anywhere from 5 to 8%. And if you've got a property which includes depreciation, you're dropping it even lower. So again, that compounding effect of those taxation benefits work really well as well. The other thing I find with clients is they're much more willing to put a larger amount in property than they are in shares when it comes to their superannuation fund. And as much as you can't go out there and borrow to go and buy a parcel of shares, I would be very surprised if a lot of clients of mine would want to go and take a loan out for $400,000 or $500,000 to go and put that in a portfolio, but they're actually quite comfortable to do that in property. I guess with this strategy as well, one of the things I find is once we've done the overall setup and everything's running pretty smoothly, it actually can be managed in a reasonably simple way. And I guess the way that we look at that is, apart from all the complexities around different structures, most of those are going to sit in a drawer or in your accountant's filing system or wherever until we go to sell that property, and we'll have to pull those out. And I'm referring to things like the bare trust and loan agreements and those sort of things there. But from a practical point of view, you're going to have a bank account, we're going to have rent coming in, payments coming out, contributions going in, and usually that can be managed with not too much more fuss than what you would do for a normal investment property. So what does this all mean? I guess at the end of the day, we want to back test and see what would be the difference in terms of putting your money in a normal superannuation fund. And in this example here, I've used an industry fund, and forgive me if these numbers are a little bit small on the screen, which you can see down the bottom there. And we're going to measure this against a property which has got a bit more of a growth focus and an income focus. So again, when we're looking at the strategy, apartments, anything with a higher rental yield, is probably not going to stack up as well as something that we're going to grow. So for this example here, we've got two clients. One's on 120,000 a year, the other one is on 100,000. We've got a starting superannuation balance of 240,000, and the property that we're going to purchase is $650,000 with with costs on top of that. Okay, so you might be thinking, well, where am I going to get a great growth property for 650,000? And it'll depend on where you're listing in from today. But in terms of Melbourne, you're probably not going to be able to go and get a property that's going to have an annual compounding growth rate of 6%. You would likely have to look outside of there. And for this example here, I leaned on some prop buyers advocates who we use from Performance Property, and they gave me a list of different suburbs in different cities that would be able to get that 6% compounding rate, and this is historical, of course. So you're looking at suburbs like Herne Hill or Manifold Heights in Geelong. There's some suburbs in the inner city south of Adelaide. You've got Perth, lesser extent Brisbane, but Melbourne and Sydney are probably out from that point of view if you look at the long-term rates. And so when we're comparing that to, say, if you're looking in Melbourne, the inner eastern Melbourne, which has traditionally had the highest capital growth rates, it's on par with those. Okay, so we're not having to skimp, we're just got to probably look elsewhere. So in terms of this example, you can see down here, if we look at the gross rent, I've used 3% there, capital growth of 6%, so we're really comparing apples with apples. We've got a loan LVR of 70%, which is less than the maximum, so we're not gearing this up to 80%, only 70%, just to give cash flow a little bit of ease there. In terms of deductions, I haven't added any depreciation in for this. Again, that can be depending on the age of the property. So really, we're looking at a freestanding home, which is pretty basic in terms of rental return. We've got 4,000 there for expenses per year outside of rentals and accounting and audit. And as you can see in year one there, down the bottom, we've got an internal rate of return of about 7.3331%. Okay. You think, well, how does that work in terms of beating a 9% return? Well, remember, this is on a larger capital base. So we're looking at a capital base of 650,000 in terms of that IRR instead of the 240, which is at 9%. So as we move around, we can have a look down the bottom there. Year one, we've lost 45,000 in terms of stamp duty and associated costs. So I've factored in, setting up an LRBA, setting up a super fund, getting advice, all that sort of stuff there is factored in. So year one, you're $45,000 dollars down. And then we go year two, year three, we sort of make that back up and we're sort of breaking even. And then really the compounding effect of all of what we're talking about today, over a 10-year period, it can be quite sizable there. We're looking at some pretty reasonable numbers. And I'd say when we're doing a strategy like this, 10 years is that minimum time frame you want to be doing something. I get a lot of clients coming in saying, all right, I'm 62 or 3, I want to buy a property in super and we want to go through and do that. Look, you can do that, but you don't want to have that as your primary asset when you're going into pre-retirement because the likelihood is you're going to retire, in your mid-60s and it's not going to work as well. So in terms of equity, we've got 10 years, we've got $808,000 worth of equity at 9%, and versus our industry super fund, which we've got 521 there. So you can see there's quite a sizable difference there. If we pull that out to be a little bit more, then if that goes out to 15 years, then we're going to see that be a little bit bigger. In terms of the tax rate, so year one, we've got 4.15% in terms of that, which, but at year 10, obviously the tax rate comes down to be around about, it slowly reduces the tax efficiency of that with the loan coming down, but then we've got 9.35%, which is much less than the 15% difference we've got there. So again, I've just sort of talked about this, but really we need that that property to have a growth rate at sort of above that 5% for that to be working efficiently. The second strategy we've got here is the 5-year catch-up rule. So one of the things that I guess this came in 2018. It's probably not been as prevalent just yet because you sort of had to wait until last year until you can really, I guess, start using it. This works very well in terms of for clients that have a total superannuation balance of less than 500,000. And what we're trying to do here is effectively use clients that haven't maximised their 25,000 per year, having an event there, which means that they would be able to utilise that. So the main one that you would look for here is probably a property sale where you're going to have a capital gain. It might be it's owned in their own name or joint names. And we can utilise the fact that they haven't made any contributions in the past couple of years to make a lump sum, tax deductible or concessional contribution into super. The interesting thing with this is, obviously, with the superannuation, self-managed super fund, we can add reserving to this. So that reserving strategy, whereby we put a contribution in within 28 days before the end of the financial year, and then we're going to allocate that for the financial year afterwards, but we still get the deduction in the current year. So really, we can, if we add the 5 years worth of 25,000 to the reserving, we've got an amount of 150,000 that we can actually put in there, which would work very well to help offset some of the tax on, say, a business sale or a property sale or something large like that. A couple of things you've got to work out for Div 293. So with the concessional contributions, will they add to the assessable income there? So if we're going over that mark, well, then we're going to have to pay 30% on some of those contributions above the 250 mark as opposed to 15. So just something to be mindful of there when planning for that. You don't want to tell your client that you're going to be paying 15% versus 47 or something like that when it's not the case for the full amount. The last strategy we've got here, which is probably a bit more, directed at clients that are a bit older, but is a very good strategy for maximising the level of money you can put into superannuation. So as Alex explained before, the rules around being able to add contributions into super over the age of 65 have changed or almost changed. Whereby you'll be able to meet, I'll make $100,000 contributions on a non-concessional basis above the age of 65. You have to be 66 or below. This strategy here is for those people that have owned their home for more than 10 years. They are both over the age of 65. If one person is under 65 and the other one is over, you're only allowed to make a contribution on a downsizer basis for the over 65-year-old. And we're able to put that $300,000 into super. Okay, so if you've got clients that have more than $1.6 million in their total superannuation balance, the only way that you can put money in above that level is your normal $25,000 contributions. We have some small business CGT retirement exemptions that you can add in there which don't count towards that cap, or we have the downsizer. They're the only ways you can bolster your super fund above that. Really, what you can do is, in terms of, if you've got clients out there that have maybe sold a property and they're looking to move into something else a little bit smaller, or in this scenario, you can actually just the actual transaction of selling that property means that the downsizer provisions can be activated, and you can actually buy something that's bigger or more expensive. So the downsizer is more around the transaction of that family home. But it is really suited for those people that are looking to do that and add more money to super. So in this scenario, we've got two people able to put $300,000 each, and then assuming that they're both over the age of 65, either meeting the work test or they're 66 years of age, we can then add those two lots of 100,000 in there as well. So in terms of, I guess, adding that strategy to things like a small business CGT concession. I had a client last month that we did this for. So really, you can, above the 1.6 mil, the way that we could get another 1.84 mil is we could put 25,000 in as a concessional contribution. We can then add, under the retirement exemption, 1.515 million, and then the downsizer on top of that being 300,000. Okay. Now, it's important when you're doing these, there's timing issues. So the way that you want to do that is especially if you're putting in non-concessional contributions, you're going to have to do those in a way that we're not going to go over the cap, and so the small business CGT will get your total super balance up. You won't be able to put the non-concessional in afterwards if that gets you over that 1.6 mil. So there's a bit of a strategy behind that. But as you can see in this example here, if we've got that 1.84 million and we're able to get that into super, versus if we have it outside, same investment strategy. The tax saving in the first year is about 18,000, which you go, okay, well that's reasonable. But what happens over that 10-year basis? It's around about the $250,000 in terms of compounding effects on top of another 80 that you're going to save just in terms of tax. So quite a sizable difference there in just getting the right strategy to be able to put that money into superannuation. And a lot of the time you've got to plan very well to do that. So I guess, in terms of, my experience with accountants and working with clients, what are clients looking for? I think in today's environment, they're looking for leadership and proactivity. I think, the thing that I guess we all get bogged down on is attending to our day-to-day roles. Clients really value that proactivity. I think the main thing that I've got, I guess, in terms of feedback from working with other professionals is it makes the client feel special to have a lot of people around them working together to get them the best outcome. And I think, those clients that feel really special all the time are the ones that will never leave you. Retain value, we know that, and have absolute trust and confidence. That's a given as well. So I think in today's environment, it's very hard to do that all as one person without having those trusted advisors around you. And I surround myself with whether it's the best buyers advocates or property people, or it could be the best mortgage brokers or the best lawyers, to make sure that I get the best outcome from my client and leave no stone unturned. So I think that's where I think accountants and their clients work best in that environment as well. So I guess, for those of you that might not have worked with a Partners Wealth Group advisor, I think there's always a lot of people within the business that might have used audit or legal or SMSF tech. But, I think, for those that might not have, our process has always been to have an initial meeting with clients. We don't charge for that. I think today in this environment, we're finding more and more for those meetings, it's quite easy to put together a Teams or a Zoom meeting, given we can't travel. And then, from that meeting, generally we'll always be able to find, 3 or 4 or 5 really key value items that we can bring to the client's attention and outline what that would do for their situation. And we do that via a strategy paper. We don't charge for that either. It's another step in the process, which a lot of other advice firms don't do. And I guess the real key difference between what we do and what a lot of other advice firms do is we work with you as the primary tax advisor, and we do things on a strategic basis. So we're not product focused, and we want to get the best outcome for the client. So there's, at the end of the day, we want to make you look good with your client. And I think that's at the core of our approach whenever we do anything. So thanks for that. In terms of coming up next, we've got Jeff from Partners Legal. So he's the head of property at Partners Legal. He's going to be talking about leasing from an SMSF to a related party. So welcome, Jeff.
Okay, so thanks, Rob, for your presentation. As Rob mentioned, my name is Jeff Manolitzer. I'm the head of property at Partners Legal, being the legal arm of PWG. So today, my presentation, I guess recently I came across a lease whereby a SMSF was leasing to a related entity, and it was a 1 or 2 page document with not very much information at all, and it kind of reminded me as to it was certainly very inadequate in terms of satisfying the SIS Act and retail and property legislative obligations. And it was a timely reminder, I guess, as to the importance of having your legal documentation certainly in hand when, especially when leasing business premises from your SMSF to a related entity. So that's what we'll be talking about today. Firstly, we'll just talk about a few of the the rules for SMSF leasing property to related parties, including just a few of the definitions, which I'm sure most of you are familiar with. So firstly, an in-house asset, as defined under Section 71(1) of the SIS Act and the SMSF R at 2009-4, which basically says that an in-house asset is a loan, an investment, or a lease to a related party. However, there are some exemptions, one of which being business real property being leased between your SMSF and a related party to your SMSF. So that brings us to what is business real property and what is a related party. So business real property, in essence, is land or buildings used wholly or exclusively in one or more businesses, and the key being they're used wholly and exclusively. So if business real property is used in primary production, so for example, farming land, it still can meet the test of being used wholly and exclusively in business, even if there is a dwelling on the site and being used for private or domestic purposes. So you can refer to Section 66(6) of the SIS Act with regards to that. But just please note that in that instance, a dwelling must not be of an area no more than 2 hectares, and the main use of the property still cannot be for domestic or private purposes. Then we've got related parties, so that's defined in Section 10(1) of the SIS Act, and again, a related party you might be obviously familiar with. We're talking about members of your fund, associates of the fund members, which do include relatives of each of the members, parent, grandparents, brothers, sisters, uncles, aunts, so forth. Noting that it doesn't include a cousin, not quite sure why, but and then obviously spouses of those relatives as well. So, so here what we have is we've got an SMSF who is leasing business real property to a related party. Now, in order to that the commercial lease must be a written commercial lease, and pursuant to Section 109 of the SIS Act, we must ensure that the lease is an arm's length transaction. And so that's what we'll focus on today in terms of how you can document a lease to ensure that it is an arm's length, on an arm's length basis. And how we can also ensure that it complies with not only the superannuation laws, the SIS Act, but also retail legislation. So just moving on, the key lease provisions. So the first thing you need to ensure as part of your leases is you need to properly define the property. So is the property a specific level, a specific suite of a building? Is it the whole of the building, part of the building? Title particulars, the address of the property. So it needs to be particularized so that it's very accurate as to we know exactly what's being leased. Does it include common property or not? So all of these details need to be outlined up front. The lease term. So the lease term again has to be a realistic commercial lease term. Now that could be anything. Retail lease could be anywhere from up to from 12 months up to 10, 15 years. So you really can't enter into a lease term of, let's say, 50 years, but certainly the lease term could be a term of 10, 15 years, and then you could have options on top of that. So the options these are the options for further terms. So most leases would have options whereby a tenant could exercise a further term of X amount of years. Again, that could be anything ranging from 1 to 5 or 10-year options. With the options, it must be particularized as to exactly how a tenant can exercise an option and when a tenant should be exercising an option. So there will be provisions in the lease typically to state typically between 3 to 6 months prior to the end of the initial term, it must be exercised, and what kind of notices that a tenant would need to give a landlord in order to exercise the option. It also outlines the provisions by which a tenant cannot exercise an option. For example, if a tenant's currently in breach of the lease at the time of exercise of an option, or has been continuously in breach of its obligations throughout the lease term. Permitted use. So, what is the lease for, or how is the tenant occupying the premises, and what will the tenant be operating? How the tenant will be operating its business on the premises. The permitted use, again, really should be particularised so that it's fairly accurate. I have seen before permitted use being anything basically as broad as any retail use, or it could also specify anything that's permitted by law in accordance with the planning scheme. That's not preferable, I guess, for these kind of leases. It really should be a bit more particularised, particularly, I guess, in these cases where we need to make sure that they are treated on arm's length and a commercial basis. And typically, a landlord wouldn't allow, I guess, a permitted use that was so wide. Then we come to rent. So again, with rent, we need to be very careful as to what rent we're charging our tenant, our related entity. In particular, I guess the rent needs to be a commercial rent. Now, that might mean that prior to the commencement of the lease, we need to get a commercial appraisal done by an agent. However, I guess, and you would obviously need to ensure that you've got relevant documentation to back that up to I guess, evidence that it is a commercial rent, or you could go down the road of a valuation done to ensure that is a commercial market rent. Need to be very, very careful with that commencement rent to ensure that it is market. Further to that, I guess you've got rent reviews. So what typically happens in a lease, as a lot of you would know, that you would typically have annual rental increases. Now, they can be anywhere from a fixed rental review, being a fixed percentage increase, 2, 3, 4, 5%. Again, don't make that something that is non-commercial, particularly in today's days. You wouldn't typically see anything above a 5% fixed review. Or it could be a CPI review, which again just reflects is a measure, I guess, of reflecting the market. Or we could have a market review. So typically what you see in commercial leases are annual rental reviews of either CPI or a fixed review, and then you would do a market review on the exercise of an option. Again, when determining the market review, we would need to put specific provisions in the lease as to how that market review is to be determined. And that is typically by agreement between the parties. And if there is no agreement between the parties as to what the market is, then to be determined by an independent valuer. In these cases, I would be cautious about having the parties agree to a market rent at a market review. And again, you would probably want to engage an independent valuer to assess what that market rent is, just to ensure that your lease is commercial. Insurance. So then we talk about some of the obligations that a tenant would need to oblige under a typical lease. And a tenant would typically be responsible for insurance obligations. Again, we're talking insurance anywhere from building insurance, tenants and landlords' property. We'll be looking at public liability insurance as well, just to make sure that those obligations are included within your lease. And then we've also got outgoings. So outgoings payable could include anything from land tax, council rates, services of the building, cleaning, landscaping, maintenance and repair obligations there as well, which we'll get to later on. So all of your outgoings should be documented as to who should be paying. And again, these should be consistent with standard commercial practices. Maintenance and repairs. This is an interesting one because quite often in leases there's sometimes very little consistency between whose obligations they are to repair and maintain. Typically, you would have a tenant would normally be responsible for the repairs and maintenance of the building itself, other than capital or structural repairs, which would be a landlord responsibility. But items such as air conditioning, for example, essential safety measures and so forth have been highly debated, I guess, in the legal fraternity as to who should be responsible. So again, they should all be documented as to whose responsibility it is, because they would be standard in a commercial or retail lease. Security. So typically a landlord would ensure that it has sufficient security under the lease if there was any breach by the tenant. Now, we need to be very careful within these leases to related parties from your SMSF that any breaches are actually enforced by the landlord, or seem to be enforced, certainly. That would mean that security would typically be used by a landlord. We can include anything from a bank guarantee to a security deposit to having directors' guarantees as security for a tenant breach. So they should also be outlined in the case that there is a breach of the lease by your related entity or your related party tenant. Make good. So make good basically your obligations on exit. So on the termination or earlier vacation of the lease by the tenant. Now, this would include everything from delivering up the premises, typically in a condition consistent with the condition as at the commencement of the lease. It could include anything from recarpeting to new window furnishings, replacing broken lights, anything that's more than just fair wear and tear. Just note also that I guess if the tenant pays for a fit out as part of the commencement of a lease, and the tenant owns that property, you would sometimes have in commercial leases that the ownership of that tenant fit out reverts or is purchased by the landlord. We will need to be careful here, though, that there is no transfer of a fit out to a landlord on termination due to the restriction on an SMSF acquiring assets from a related party under Section 66 of the SIS Act. So it's these kind of provisions that we need to be typically very careful of when drafting a lease between your SMSF and a related entity or a related party. And as mentioned before, with respect to default or breaches of the lease, the landlord needs to or is obliged to enforce the lease provisions. So therefore, we would need to include default breach provisions of the lease as to determine when a tenant is in breach and what would be done on a breach. And as suggested, applicable notices must be given under the lease to ensure that it's seen as an arm's length commercial basis. So there are a few of the key lease provisions that would go into a related party SMSF lease. Then what we've got is, I guess, COVID-19 and how this affects your leases and what can or should be done, I guess, when if you wanted the related party tenant to be granted rental relief. Alex touched on this a bit earlier in our presentation and did mention that the ATO did put out some guidelines in their frequently asked questions. But what we need to be very careful of is, extreme care must be taken to ensure that any rent relief granted doesn't contravene the SIS Act. Broadly, the ATO, as mentioned by Alex, will not actively seek out cases where an SMSF will gives a related party tenant temporary rent relief for the financial year of 1920 and 2021. Whilst the ATO should be congratulated on their practical approach in this regard, SMSF trustees should not really rely on this non-binding guidance because of the substantial downside consequences, and should be very careful when implementing rent relief. Remembering that this needs to be a commercial transaction, really any rental relief should follow the applicable commercial tenancy relief scheme released by the government in early April of this year or late March of this year. Summaries of this, we have published an article on the PWG website, which goes through the commercial tenancy relief scheme of the government and what must be done, I guess, as a landlord when a tenant requests rental relief. In this instance, I guess if you have an SMSF that's leasing to a non-related party, then it's up to that tenant to make that request and follow the applicable guidelines as per the government legislation and regulations. If it is a related party, then again we would suggest that it still complies, I guess, with the Act and regulations. Just note that the initial Act and regulations were due to expire on the 29th of September this year. There have been some recent amendments, and an Extension Act has been passed by Parliament to basically extend the commercial tenancy relief scheme until the 31st or the 31st of December this year. However, there have been some differences in that. So just got to be careful that if you want to give rent relief to a related party tenant, in these instances, what we would do is a tenant typically has to apply for rental relief, and it would be wise to have some written correspondence from the tenant to the SMSF landlord to suggest that they've requested that rent relief. That tenant must also provide a statement as to the decline in turnover associated with the actual premises. So that's something that's just recently come out. Post the 29th of September, the tenant must actually show in the request to the landlord what the turnover, the downturn in turnover is associated with the premises, not the business as a whole, if it's got other shops or premises that it's operating its business from. The offer made by the landlord must be in proportion to the decline in the turnover that's associated with the premises. So there's, whilst Alex did say that there is potential that you could have 100% rent relief, you've got to be very careful in doing so, that if the tenant's business has shut down and the turnover is 100%, then by all means that may be the case. But if the downturn, for example, is only 50%, then it would be wise to ensure that the rent relief granted by the landlord, the SMSF landlord, is in proportion to that downturn in turnover. Also, the regulations do state that the landlord is able to provide a combination of a waiver or rent reduction. Just be careful again that the waiver must be at least 50% of the rent relief that's being requested, and then you could defer the balance of the rent relief there. So again, I guess what we're saying here is that the few lessons from the COVID-19 relief scheme is just to be very, very careful, and extreme care should be taken when providing rent relief to a related party tenant. And everything should be appropriately documented, including a request by a tenant for rent relief, and then the final changes to the lease should also be documented by an experienced lawyer, just to make sure that all the written evidence is there. So moving on to, I guess, the benefits of a properly prepared lease. One, I guess it increases the likelihood that an SMSF auditor will be satisfied during their annual audit processes that everything's in place and that there are no breaches of this Act. It, in turn, will reduce unconscionable conduct claims against your SMSF. If the related party tenant was to sell its business, it will certainly make selling businesses a lot easier because there is a lease in place already, and they can clearly see the terms and conditions of the lease that they'll be taking on as part of a potential transfer. It also provides benefits, I guess, to the SMSF landlord in that it could provide benefits to that landlord when dealing with future tenants after a business sale. So the commercial terms, whilst still commercial, things such as if it's a non-retail lease, the passing on of land tax might be included in that lease. So you can draft up a lease whilst commercial. It still might benefit a landlord when dealing with third-party tenants if the related party tenant was to sell the business. And in the long run, it's going to save you legal costs, because if you do it properly the first time, you won't need to go see your solicitor for any potential breaches of the lease, or to draft up a new lease further down the track. So, as I said, if you require more information on the COVID application and how that works, not only I guess for an SMSF landlord to a related party, but where an SMSF is leasing to a unrelated party, a third party, or just generally leases, if you've got clients that have leases and are dealing with the rent relief provisions. Summaries are on our website. Otherwise, please feel free to contact me about anything within the presentation. So I'll now pass over to Alex, who will complete our final presentation for the day. Thank you, Alex.
Thank you, Jeff. Okay, I'll just. So unfortunately, Christian wasn't available to do this presentation. And it's a particularly good topic at the moment, because we've just had a recent case in the last couple of months. So I thought it'd be worth just going through that presentation with you all. So we're going to talk about the long and binding road of BDBN and some war stories, and also go through some of the legislation that's gone through to the courts to see where we're at. So there's been a voluminous body of case law work that continues to grow. The decisions in the courts have generally supported the use of BDBNs, but it's very clear that you need the right people in a case to be a good predictor of success. As I mentioned recently, there was a Marcella case decision, which also cautions trustees against making absolute discretion. But we'll go through some of the key principles of BDBN so you get an understanding of how the case law has grown. So the first decision was Katz and Grossman. I've mentioned that before, and our legal colleagues have mentioned this case a number of times. This was an individual trustee, husband and wife. The wife died, and she appointed the daughter. The father said, look, on his deathbed, look, I really want my money to go to my two children, my son and my daughter. The daughter, upon the father's passing, appoints her husband as the trustee. The father did not have a BDBN, but the daughter decided, look, I'm going to pay that money to myself. And I didn't really like my brother, so he's getting nothing. So the brother decided, look, I'm going to fight this. So he took it to trial, and he argued the point that the sister, or his sister, was not appropriately appointed. And the judge came out and the judgment was that the daughter prevailed, and she was entitled to do her own discretion. She was appropriately appointed in accordance with the trust deed, and the trust deed allowed her as a trustee to exercise discretion because there was no BDBN in place. Our second case talks about that the BDBN must be integrated with the entire estate planning. So in this case, we had a wife that wanted to pay her super to her children from a prior marriage, and she was married and had the husband in the super fund. She didn't make a BDBN, but when she went to her lawyers, and she had a very detailed will prepared. And then the will said, look, I want all my superannuation money to go to my children. Well, the husband was the sole director of a corporate trustee, and he looked at the super fund trust deed and said, look, I'm going to pay it to myself. Now, the estate challenged the case and the will, and on the basis that they missed out, and the will said, look, we're getting half the money. And the court found that the will does not have any impact on the super fund trust, and that the attempt to bind the trustee discretion was not correct, and they need to follow the trustee rules. Our third case of case law talks about getting the formalities wrong. Now, this is a case of Munro versus Munro. Munro was a lawyer. He prepared his own BDBN. It all got witnessed properly, but he made his nomination to the trustee of a deceased estate and not the legal personal representative. His wife must have been pretty savvy with the legal terms, realised that the BDBN was invalid, and instead of paying the benefit to the children, which was in the BDBN, or to the estate, and the estate was going to allocate it to the wife and the children, she decided to take 100% of the money herself. The estate challenged the determination, and because the BDBN was not valid, it failed. And I didn't write this, but Christian wrote, "Some lawyers are idiots." Our fourth case is, again, a war story about having the wrong people in charge, and it's all for naught if there's no cash left. In Worcester versus Morris, the husband got a proper BDBN in place. He had it all properly prepared by his lawyer, and the court said that the BDBN was valid. But the wife decided, look, she didn't want to ignore the BDBN because it didn't pay the money to her, it paid it to the children. And so she decided to pay it out to herself, and the children challenged that, and the children won, and the money should have gone to the children. However, she was allowed to deduct all the legal costs for her fighting this legal battle from the super funds asset. So when the money did go to the children, there was basically half the funds left. So just to recap, trustees usually do whatever they want to do. Members don't understand that there is actually a difference between super funds and your estate. A super fund is governed by trust law. Your estate is effectively everything that's in your personal name. BDBNs can fail if they're not done properly, and they fail for some pedantic rules. And if you do have the wrong people in charge, the beneficiaries are ultimately the losers. That brings us to the 2020 case. This was found recently found in the last couple of months. What we have here is Helen Masella and her daughter as the second trustee. The mum decided to have a BDBN in place, and she directed all her money to go to her grandchildren. Now, the problem with this BDBN is that grandchildren are not dependents under the SIS Act. And so you cannot have a valid BDBN for grandchildren. If there were to children, fine. The only way you can get your money to your grandchildren is if you direct your money to your estate, and in your will, you then direct the money to your grandchildren. So the BDBN was not valid because grandchildren are not dependents. And the BDBN was also invalid because it was a lapsing BDBN, and it was over 3 years. So the daughter, a bit like we had in Katz versus Grossman, she appointed her husband as co-trustee, ignored the BDBN, but that's because the BDBN was it not valid, and she paid the benefits to herself. Now, the factor in this fund was that the husband of Helen, of 32 years, not the father to the children, thought he was entitled to some money. And he was the executor of Helen's estate, and he said, look, I'm going to challenge this. And he said there should have been an independent trustee appointed, not too different to what the son did in the Katz versus Grossman. And what was held was that the daughter was, as the trustee, had a fiduciary duty. And her fiduciary duty was that she had the discretion in the absence of BDBN, but she must exercise her duties in good faith upon real and genuine consideration. So the daughter did not consider that the second husband of 32 years was not a potential beneficiary, and she was ill-informed arbitrariness or self-interest that resulted in her paying the money to herself. The court concluded, based on the evidence, that the trustee acted with disregard to her duties. She did not understand who the beneficiaries of the fund were. The decision was based on the correspondence between her and her advisors, so the accountants and advisors and lawyers that she had sent emails to. The court looked at the correspondence, and there was no mention of giving the money to the second husband or as a beneficiary, but she owed duties to beneficiaries. all beneficiaries as trustee of the fund. And so court noted that the second estranged husband, there was inferred bad faith, that she basically paid the money to herself in bad faith. And what's important to have is that you've got your valid documents, but you've also got the correct people in control. That all trustee decisions have to be made with the fiduciary duties, and they can be overturned. The issue is that the trustee, so the issue with Marcella, which is different to Katz and Grossman, was the decision was the way she paid out the benefit, not becoming the trustee, the manner in which the decision was made. Oh, sorry, it was the fact that she made the decision to pay it herself, not that the fact that she got the money. She could have been entitled to the money if she gave due consideration to all the beneficiaries. So, an example, if she gave, say, $5,000 or $10,000 to the second husband and took the rest, that may have been a valid decision by the trustees. And what's important here is that the trustees need to make inquiries into the circumstances of the beneficiaries and the requirements of the deed when making their decision. So when I mentioned Katz and Grossman before, so Katz and Grossman was a similar scenario where the trustees made their decision based on using their trustee discretion, but Marcella doesn't overturn Katz. So technically, Katz versus Grossman, the son said, look, she shouldn't have been appointed as the trustee, not that she made the bad decision. Whereas Marcella was the fact that the trustees made a bad decision because they acted in bad faith. So if the lawyer for Katz decided to argue the point of law of bad faith, there's most likely would have been successful. So this is an important, I guess, case law because it now it's the first time that they've put on a notice that the trustees' decisions have to be documented that they're not acting in bad faith. The advisor should be expected more trustees will be challenged. Now, I mentioned previously that before Parliament is the option of increasing your trust membership from 4 to 6 members. Now, if you increase to 4 to 6 members, you're going to have more children, more fights, more challenges. So therefore, if you don't have BDBNs in place, you will probably have more cases come to court when you've got more fighting children over the funds. The trustee's decision to pay it to itself can be a valid excuse of discretion, but the courts would have scrutinised the manner in which you made your decision and all the correspondence that you do. So you've got to be very careful on what you say and do when you email your accountant or advisor on how you want to proceed, because all those documents will be scrutinised by the courts. So I think that's a good example of getting more pressing need of having a BDBN in place, because a BDBN basically trumps any of these sorts of litigations that happen, so long as it's done by a proper form and it's been executed properly, and it's made to assist dependents. But we also caution that you should also look at the trustee to make sure that is up to date before doing any BDBNs. So today we've had a fair bit of information. I'd like to finish up by saying thank you for attending. We have got the contact details of all the presenters, apart from Christian, who didn't attend today. If you have got any questions in relation to any of the items mentioned today, or you've got some questions that might impact your super fund, look, please reach out to any of the people today. We'll be in contact with you in the next few days just to talk through those matters. It's just that we haven't had that the engagement forum with webinars to be able to address your queries today. But again, we're getting close to bang on time, so I want to probably close that presentation and thank you very much for your time.